This is the Asia Trade. I'm Sharon in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the markets have just opened for trade. The top stories this hour. Asian stocks are set for a positive open after big tech leads a Wall Street rebound. Front-end treasuries rallying as traders assess the latest Fed commentary. Chinese equities looking to regain some of yesterday's reversals, but doubts linger about Beijing's commitment to fiscal stimulus. A New Zealand central bank set to deliver a rate cut today, trying to get ahead of that worsening economic outlook.
Haidi will also be watching the debt markets, especially a strategy that was very popular with catastrophe bond investors. We do have Hurricane Milton now barreling through Florida. This could be a century hurricane at the moment, because we haven't seen really a magnitude of this hurricane really hit a metropolitan area like Tampa in about a century. So we are now expecting to see those damages and losses rising to more than $150 billion, according to some models, and catastrophe bond investors really bracing themselves for really what this could mean for insurers and, of course, just tragedy and the magnitude of what's happening here across the U.S.
As we continue to watch for how that plays out, of course, we're also watching for further developments when it comes to the Chinese economic stimulus story and whether the amount of stimulus and the details that we've had delivered by policymakers so far is really going to be sufficient to be able to deliver on further gains when it comes to upside for Chinese risk assets, right? This is how we ended the day. The CSI 300 putting on close to 6%. We did see that reversal, though, when it comes to markets that perhaps have run a little bit further ahead, offshore markets in particular. The Hang Seng seeing that big decline. We're also seeing H shares really seeing the bulk of those losses, as of course we've had that pent-up buying demand with onshore markets being closed for the week-long holidays. But there is a sense that the markets are sending a warning, right, that Xi Jinping, that his policy-making team, is going to need to do more to fuel the next leg of this rally. A lot of that is being asked for when it comes to fiscal stimulus, as opposed to just the monetary side that we've seen it being heavily concentrated on. We are also watching central bank decisions. Of course, we were talking about the RBNZ just a little bit earlier at the top of the show. We also have the RBI. When it comes to the RBNZ, it's still a little bit of debate as to whether we get 50 basis points. Certainly, if there's a 25 basis point cut, we will see that reaction when it comes to Kiwi assets. We're also watching for the RBI as well. That's really seen moving closer to that cycle of easing.
Yeah, we'll be watching the reaction when it comes to Asian markets on that disappointing announcement from China's top economic planner. Take a look at how the offshore yuan is trading at the moment. It's pretty steady. Of course, we'll be continuing to watch some of those China-exposed stocks across Asia. Right now, Nikkei futures gaining 0.2%. We continue to see the downside pressure on the Japanese yen. Right now, a little bit steady at that 148 level against the U.S. dollar, but really a lot to do with what's happening on the dollar side of things, because we're seeing the longest winning streak in more than 2 years, with the dollar gaining for 7 consecutive sessions. Take a look at how U.S. futures are coming online right now. We had some downside pressure when it came to the Golden Dragon Index, seeing its fourth day in 2 years. So U.S. listed Chinese stocks, Beijing not announcing more stimulus. But we did see the Magnificent Seven chip makers leading the gains. And of course, we're really also looking forward to the U.S. inflation numbers as well, expected to have moderated slightly. Crude prices at the moment gaining 0.5%. We continue to watch the geopolitical tensions in the Middle East. When it comes to China, Goldman Sachs has upgraded its call on Chinese stocks to overweight, seeing a further 15 to 20% upside potential on Beijing stimulus plans. With us now is Tim Moe, Goldman's co-head of Asia Macro Research. Tim, so good to see you in person finally.
It's great to be here. Thank you so much.
On a very rainy Tokyo day.
Indeed.
But when it comes to the markets, what sort of reaction are we expecting from Asian equities, given that we didn't get that sort of major stimulus that we were expecting?
Yeah, so yesterday obviously was a very significant pullback, but I think we have to remember that that came in the context of the market being up 38% from the low on September 11th. So we had a huge run and a lot of expectation built up about easing. And in conversations with with investors over the past few days in the run-up to the NDRC meeting yesterday, there were some overly inflated expectations about, first of all, what might be announced and then the magnitude of what might be announced. So what was indicated in various press rumors in the media around the time that Xi Jinping and then Li Cheng were making announcements on fiscal was about, call it 2 to 3 trillion renminbi of stimulus. expectations then inflated to up to 10 trillion, which was wildly overly optimistic. And so I think there were a number of, you might call them tourist investors, who were unaware that the NDRC meeting was never one that was going to have those sorts of announcements.
We do have the finance ministry meeting coming up.
When you see the Ministry of Finance, which is where fiscal stuff would be announced, number one, and number two, it's the National People's Congress Standing Committee meeting end of this month or early in November, which will be when the official ratification of such policies would be announced. So those are the really two key events we need to look forward to. So I think what's happened is that the market was overly optimistic, overly inflated, momentum indicators super hot, and we had an outsized correction, but I think it's within the context of what should be expected.
And within the context of you expecting up to 20% increased returns.
Yeah, so to put some quick numbers on it, so we think that what's happened in terms of the announcement on policy support effectively takes out some of the downside risk to growth, and the market was pricing a lot of that. So to give the numbers, on September 11th, the Chinese offshore market was trading at 8.4 times forward price earnings ratio, very, very low. We think it's worth about 12. In the course of the rally, it got up to just shy of 11, and now we're back down to 10.8 as of last night's close. So we still have some, call it 1.5 multiple points we could expand, and as we go through time, some earnings growth, and you put those two things together, you get 15 to 20% without stretching the imagination.
Tim, do you characterize this as a tactical rebound or more of a strategic, fundamental shifting in the way that we look at China? Is it too early to be able to make that call?
So, Heidi, that's a great question. That's really the top of mind question that many investors have been asking us. So thank you for asking it as well. The simple answer is that there's just not enough information to make a call that this is a structural bull market, because that would effectively require assuming that all the many macro challenges that China faces, which are well known in terms of demographics and debt and property market and domestic policies, as well as geopolitical risks, that all those magically have gone away with a few policy announcements by the central bank and by President Xi and so forth. So there needs to be more substantive evidence of what actually is being done to structurally address some of those challenges. So I just don't think we have enough information to make that call. But the key thing we would say, if I could, is that if we look, say, for example, at the Japanese market history over 30 years, there was fundamental bearish conditions, but you had 7 rallies of 50 to 140% lasting 2 quarters to 2 years. So very tradable moves, even within a very negative fundamental environment. I'm not saying it's a perfect analog, but it's interesting historical evidence that even in a challenged environment, you can have moves that could be very consequential for investors. Do
you subscribe to that narrative of perhaps Japanification of the Chinese economy?
So we've written a lot about this from the economic and strategy perspective, and the high-level summary is that there are a number of clear parallels, but there are a number of big differences as well. And I think one of the big differences is that China policymakers, who are very well aware of their historical context, actually have the Japanese example to see what went wrong and sort of what went right. And I think that can serve as a helpful guide to conducting policy to help China navigate through some of those macro issues. But the key issue here is, of course, they need to do that and then implement it. I think that's really what the market is focusing on.
The issue is a lot of those macro issues are long-term structural that have been a long time coming, right? And then you've got sort of external risks as well. How much concern are you assigning to what happens after November, for example, and meaningfully what it means for China, but of course for sort of broader trade flows and tariff implications more broadly?
So there are clear issues, and that's one of the things the market is looking at. In fact, and we thought there might be some correction perhaps next week. It happened a bit earlier, but we've been expecting something. First of all, markets never go in a straight line, and when they're that overbought, there's always some inevitable profit-taking by the shorter-term, higher momentum money. But also, if we project ourselves forward to next week, we're just going to be 3 weeks shy of the election, and of course, with uncertainty about the outcome and what that means from a policy standpoint, it would be a natural time for some locking in of gains by shorter-term traders. We have to wait and see what happens, but if there are tariffs that emerge in the aftermath of that, then we have to see what the magnitude is, what the nature is, and what the potential response is from a policy offset perspective by China. So there is some uncertainty going into that, which we will need to see. I mean, if significant tariffs are levied, obviously there will be some downside risk, everything else being equal. But then, as I said, we need to see what the corresponding policy offset might be in order to really gauge the effect of that.
So we had a great chat up before looking at the CSI 300 momentum near the highest ever, right? Maybe we can get that back up again. I think that sort of goes to what you were talking about a little bit earlier. At this point, still riding the sort of tactical aspect of what we're seeing. How do you play China at this point? Where do you see kind of the biggest opportunities, given that we have had this run up now?
So there are a number of areas. I'd say the one we just flagged in a report we put out yesterday would be the small and mid-cap China A shares. So the quick logic there is, number one, the market was closed for a week and only just reopened yesterday. But actually, the people who just opened up new accounts, they can't trade until today. And in fact, we saw some hedge fund shifting from H shares to A shares yesterday in the record turnover volume in Hong Kong in order to get ahead of that theme. So when retail investors come back, typically they go for the smaller and mid caps. That's the clear characteristic of the Chinese A share market. So, for the higher octane part of the investment spectrum, I think that's the area to look at, the smaller and mid caps in the A shares.
Does a rally in China risk pulling flows away from other markets?
Another great question, which we've had a lot. And a lot of people say, is that going to cannibalize returns in Japan, for example, or India? Those are the two markets that are most cited. The answer is, a bit, but not as much as people might think. And the quick reason is that asking that question assumes that there's a closed universe of money that only invests in Asia. So if you're going to, the expression rob Peter to pay Paul, if you're going to have, invest in China, therefore you have to sell something else. That may be true for people whose mandate is just being in Asia and have to be fully invested. But there's much more money globally that's run, which could sell, I don't know, Brazil or South Africa or Europe.
Yeah, you're not mentioning the U.S. right now because it's doing so well right now.
It's doing very well. But my point is that, other money could come from other markets and other money could come from other asset classes, bonds or money market funds. So, it is possible, and we've shown that in the past 20 years, there have been nearly 20 rallies in China of 20% or more. And we just looked at this for the India market. India's gone up in about 90% of those. Now, it's underperformed about a little bit more than half of the time. So in relative performance terms, when China has a rally, India might underperform. But in terms of would India go up when China goes up, the answer is most of the time it does. Right. So it's possible for the rising tide of positive sentiment to lift all the boats.
Japan has already risen so much. What do you make of the narrative right now with the new government? Because they seem to be walking back a little bit of what was perceived as more hawkish in terms of BOJ policy.
That's right, Shery. So I think there was some market concern, and it sold off when we had the announcement.
The Ishiba shock.
Correct. Yeah, we announced with the new prime minister. The market sold off, and as you said, I think that the rhetoric or the policy guidance was walked back somewhat. This may be another example that during campaigns people sort of say one thing, but then when they're actually in power, you realize that you have to have some compromise, and that may be another example of that. Our core view in Japan remains constructive. We think that with the market trading sort of 14.5 times earnings, with earnings still growing high single digit this year and next, interest rates domestically still very low, even though they're going to rise at a moderate pace. We're still talking about 25 basis points is the current rate, and that might be going to even 1% in a couple of years, but still super low. And in the context of all that, and also with the bottom-up corporate change, which is a key theme we've been liking and many investors have, we still think that there's good risk-reward in Japan.
Geopolitical shock, especially given that we have so many oil importers across Asia.
Well, yes. So number one, India had a sell-off last week. It's down 4%, and it was on two reasons. A, because the SEBI, the stock exchange overseer, was clamping down on some of the very, very frenetic trading in the single stock options market. And number two, oil prices were rising. India tends to trade inversely with oil because it's a significant oil importer. And the market was up a lot, so it was a natural time to take some profit. So one of the things we flagged in our recent China report, in addition to all the China-focused stuff, was the theme of defense spending. We've been liking this for a couple of years. Defense spending is going up across the board, everywhere, and especially in Asia. So we've been flagging the theme of defense stocks, and what we like about that, not only are they profitable and making money, and there's a strong fundamental dynamic, but also when geopolitical risk rises, they tend to outperform. So you have a natural hedge against rising geopolitical risk, which tends to be negative for markets broadly. If you have defense stocks, they tend to outperform and do well in that environment. So you kind of have a little bit of you can have your sort of cake and eat it too with that theme.
Tim, great to have you with us, especially here in the Tokyo studio. Tim Moe, co-head of Asia Macro Research at Goldman Sachs. Haidi, and of course, we'll continue to really look forward to market trading today. Lots to discuss, especially on central bank policy.
Yeah, absolutely, Shery, because coming up on the Asia Trade, ANZ Bank previewing what could be a jumbo rate cut in a couple of hours from the RBNZ. We'll also be talking market strategy with AXA Investment Managers, and FTSE Russell joins us a little bit later on. South Korean bonds getting the green light to join their benchmark global index. But first, Florida residents running out of time to escape as Hurricane Milton closes in amid warnings of life-threatening winds and flooding. We get the latest next. This is Bloomberg.
Take a look at live pictures of Tampa right now as we are now seeing that Hurricane Milton, Category 5 hurricane, really barreling through Florida's west coast. We are expecting that flooding and high winds. They're expected to inflict widespread damage, put lives at risk as well. This would be the first direct hit for a metropolitan area from a hurricane in a century. Let's bring in Bloomberg's weather reporter Brian Sullivan, who's been following the latest developments. What's going on right now, Brian?
So the hurricane has reached its maximum power. It's about 165 miles an hour or 265 kilometers an hour. The U.S. Measures its winds a little differently than the rest of the world, so it's equivalent to a super typhoon. And the question right now is where exactly on Florida is it going to hit? As you mentioned, if it hits Tampa directly on, if it's a direct strike on Tampa, then we're talking hundreds of billions of dollars of damage possibly.
We've seen many choose to escape the area by air. What do we know in terms of the ability to do that, and also by road, right? Are we seeing disruptions when it comes to flights, when it comes to the ability to be able to leave that area by car?
Right. Some of the airlines have already sold out, and they don't have any more seats for people who want to get out by airplane. And then, of course, flights are being canceled as well because the airlines have to move those very expensive planes out of the way. The roads, they've kind of opened up the roads to let everybody out as quickly as they can. They've actually built shelters inland so that people, if you get stuck in traffic, you can at least go to some place that's going to be safe. And they have buses that are just picking people up who don't have any other means of transportation and getting them away from the coast.
And all of this is coming at a time where residents and businesses are still picking up the pieces when it comes to Hurricane Helene, right? What are the cumulative consequences here for the region?
So for this entire region, you just saw Helene go through, and that caused upwards to $100 billion in damage and flooding all the way through the Appalachians and across northern Florida, and now you have another storm that could potentially rival that. So this entire section of the country, the United States as a whole, is going to take a major financial blow.
Bloomberg's Brian Sullivan there with the latest. Well, coming up next, Israel's defense minister postponing a planned visit to Washington for talks on a common strategy against Iran. We get an update on the Middle East crisis next. This is Bloomberg. Take a look at how we're tracking when it comes to oil. The China side of the story is sort of preoccupying sentiment at the moment. We saw that plunge in disappointment as China's top economic planner failed to come through with further definitive stimulus. It was high anticipation ahead of that briefing on Tuesday that we might see more details being announced. That sort of sparked a broader risk-off mood, and certainly the putting a question mark over the demand side when it comes to oil trading. We saw both Brent as well as WTI snapping that 5-session rally apiece. The NDRC saying that it's confident that China will reach its economic targets this year, but the lack of new spending being announced was certainly a disappointment. We're also hearing some more calls when it comes to what could happen if Israel hits Iran. We're hearing from the hedge fund manager Andurand that Pierre Andurand, I should say, that we could see a surge of $10 to $15 if that happens, but that the attack would not be a game changer. In the meantime, the Pentagon says a planned US visit by the Israeli Defence Minister has been postponed. Bloomberg's been told it's because of last-minute objections from Prime Minister Benjamin Netanyahu. Bloomberg's Michael Heath joins us now for more. What do we know?
Well, yeah, so it's kind of interesting. There'd obviously been a couple of days of build-up that this visit was happening. The US is sort of saying that it was actually more just operational, professional matters. It wasn't as though it was some, gathering to discuss what will happen about Iran. Obviously, there'd be discussions about it, but, to strategise on it. But in the last minute, Prime Minister Netanyahu has nixed that visit. Now, the Defence Minister and Netanyahu have had a pretty difficult relationship. They have had different views on how to prosecute the war, on the ceasefire. Gallant, the Defence Minister, wanted to attack Hezbollah early in the piece as well. So yeah, they've had some difficulties, and we saw earlier this year with another opposition leader, Benny Gantz, who was part of the cabinet, has since resigned, that a similar visit to the US was nixed by the Prime Minister as well. Now, in Israel, the Prime Minister has the ultimate say on members of foreign visits by cabinet members. Apparently, the view is that Netanyahu wanted, number one, that he talked with Biden first. A separate New York Times report was saying they haven't spoken actually since mid-August, so that's quite some time. And that he wanted Israel to have sort of decided for the Security Cabinet to have met and decided on what they were going to do about Iran before the Defence Minister went off to the US. But it does seem like there's an element of politics to all of this.
At the same time, we continue to see these operations on multiple fronts, right? We did hear from Gallant also saying that not only had they managed to strike Nasrallah's replacement, but also potentially the backup to that replacement or the successor. Yeah,
I mean, last week there was a huge bombardment on the one of the sort of headquarters, I guess you'd call it, of Hezbollah, and Hezbollah has since come back and denied his. He further said that basically Iran will find when the smoke clears that it's got nothing left there in terms of Hezbollah. Hezbollah said that's not true, and they fired 135 projectiles at Israel yesterday, which suggests that's right. They're also saying they're detonating roadside bombs and these sort of things, attacking Israeli ground forces. More Israeli ground forces have gone in as well. So Hezbollah is alive and well, despite what he said. But nonetheless, I mean, Israel's ability to keep targeting successfully these leaders, and we're not. Right. It hasn't been 100% confirmed, but it's quite amazing what they've achieved there.
Are we still expecting a direct retaliation against Iran?
Yeah, I mean, Shery, that's definitely on the cards. I mean, just the Israeli official was saying yesterday that it will be a significant response, and I don't think there's excuse me, I don't think there's any way that Israel could avoid that, no matter what. As I've said previously, that Israel didn't attack Iran here, so it's been trading fire with Lebanon, with Hezbollah in Lebanon. So for Iran to then fire missiles at Israel, it's basically a declaration of war, and Israel must respond for its own credibility, and just to make it clear also that there's a price always in attacking Israel, and I think that's what Prime Minister Netanyahu has been making clear. But we're not sure when it will happen, and this delay in the Defence Minister going to the US suggests that perhaps it'll take a few more days as well, or perhaps even longer. They're not on Iran's timetable; they're on their own.
Thanks, Michael Heath there. More ahead on the Asia trade. This is Bloomberg.
JPMorgan CEO Jamie Dimon says the Fed was right in making a 50 basis point rate cut to avoid recession and tackle rising unemployment. Dimon spoke exclusively with Bloomberg, also weighing in on the U.S. economy's trajectory and market valuations.
Soft landings are hard. I hope it happens. I don't know. I just wouldn't count my eggs in that one.
Do you think
and markets are open. When you say open, they're very, values are high. They're not low. Both equities and bonds, credit spreads are very low. So they're open, but people are saying they're not open for IPOs. So some IPOs, when we just did one of the largest ones of the year, like last week, they're open for those who the market wants to buy today. But don't assume that they're not open. And, sometimes people would go public, they don't like the price. That's a very different thing. And you should think twice about that. When you think what a company's worth much more than the market might know.
that maybe it's an assessment of what you're looking for rather than the actual market being closed.
Exactly.
You said that there are a lot of inflationary things that are coming down the pike. Do you think that it was a mistake for the Fed to cut by 50 basis points?
No, actually. I mean, you got to separate the here and now. Inflation has definitely been coming down. They don't want to go into recession. Unemployment has been going up. They raised rates. They were late raising rates, but they raised it very high, rapidly to 5%, which I think is the right thing. And they're right to take their foot off the gas in that one. I don't think it matters that much, 50, 25, honestly. But I think that was okay. If inflation comes back, I'm looking at future things. The remilitarization of the world's inflationary. The fiscal deficits of the world, and particularly the United States, are inflationary. The green economy is inflationary. Demographics are inflationary. It's very possible energy prices down the road, I'm talking about 2 or 3 years, will be inflationary. Those will hit later. They should react at that time to those things, but I don't think you can anticipate that. We don't know that that's going to happen.
I'm so glad you brought up the deficit. I watched the Treasury auctions. There's another 3-year one today. I watch them every time wondering, are we going to start seeing disruption from some of the concerns that that you bring up, but also every single investor who I speak to says the same thing. Are you surprised that the market hasn't priced in a higher structural deficit in the way of higher yields or at least more volatility, at least at auctions?
Yeah, well, I have a lot of comments on that one. Commodity markets often don't price things in until they actually happen. And so it hasn't happened yet. The higher inflation, the higher structural stuff, even though the deficits are there. There's also sentiment, inventory, supply and demand of capital goods. So it's very hard to say. But that's why I think that longer rates may actually stay here and tick up a little bit as opposed to go down, because of these huge deficits in the United States. And then the market's reacting, which the word you used of volatile or something like that. It's not always bad. I mean, I think we overreact sometimes to volatile markets, but I do think they'll happen again. Dealer inventories are very low. The big market makers are very constrained. Not today. I mean, we have this anomaly where JPMorgan is going to have $1 trillion of cash and unable to intermediate in treasury markets or repo markets completely conservatively, because we're required to hold that cash in very, like central bank reserves, something like that. So I think when QE finally gets to a certain point, you will see that. I may be wrong. And again, if it happens, I don't think it's a disaster. It's not bad for JPMorgan. I do think policymakers will get upset. They don't like seeing that type of thing. And I think there are fixes to it, and I think they start working those fixes today.
JPMorgan CEO Jamie Dimon speaking exclusively to Bloomberg's Lisa Abramowitz. Take a look at how futures are trading at the moment. This, of course, as we were hearing from the Fed Vice Chair, Philip Jefferson, in prepared comments saying that employment and inflation goals are roughly in balance. He expects inflation will continue to move 2%. Of course, we'll get more indications of U.S. inflation with CPI numbers out on Thursday and what that means for the Fed's trajectory. U.S. futures not doing much at the moment. We'll also see a little bit of reaction perhaps in the Asian session, given that we didn't get the major stimulus package that we were expecting from Beijing. At the moment, Nikkei futures pointing to the upside, while the ASX 200 is also seeing 0.4% gains. Of course, we do have Kiwi stocks right now gaining for the first time in 3 sessions, Haidi, as we head towards that rate decision.
Yeah, and take a look at in terms of expectations of how markets are shaping up at the moment, there is still that smaller risk that we could see just at 25 basis points. Our next guest says that is quite finely balanced in terms of the arguments, but a majority of economists do see 2 back-to-back 50-point moves. And if you take a look at sort of the background of how they would be sort of trying to undo after over 500 basis points of hikes, you could see that argument for perhaps moving it a little bit faster in light of that deteriorating economic backdrop. Let's bring in Sharon Zollner, though, who's a chief economist at ANZ New Zealand. Sharon, really great to have you with us. So, on the balance of risks, should they be going bigger given the magnitude of the tightening cycle that they're following?
Well, on the one hand, the official cash rate is still clearly well above neutral, so that will give them comfort in making a bigger cut. On the other hand, the early signs are that the economy is already starting to respond to the rate cuts that we've seen. Of course, there's been much more than just the 25 basis point cut in the OCR. The whole yield curve has moved down as the market has anticipated more aggressive easing than the Reserve Bank itself forecast back in August. So it seems likely that rate cuts are going to be just as potent as the rate hikes were. But here and now, the economy is clearly weak. So while we don't think the Reserve Bank will be revising down their forecasts for either activity or inflation particularly, it is reasonable for them to have more confidence in those forecasts. And really, whether they go 25 or 50 is going to come down to the question of how confident they are that that near-term disinflation is on track and that the medium-term picture is favourable.
We did even see the report that the RBNZ shadow board was quite divided over the size of potential easing that should be happening at the moment. When you take a look at the projections, what will you be watching out for?
Yes, so 10 days ago, economists were quite divided as well. So it has come relatively late in the piece. There was a business survey in particular that showed quite a sharp fall in pricing intentions and capacity indicators. But obviously, the market moves on in milliseconds from the actual decision to looking at the next one. So any hint about what November might bring will be seized upon. We think it's really in the Reserve Bank's interest to remain very open-minded about that and stress that it's going to be data dependent, because it is 1 week until we get the CPI data, which is obviously going to be crucially important, but we will also get information about employment and unemployment before that decision. So some very, very big data prints to come between now and then.
We saw business confidence already showing that surge to a 10-year high. What is the sentiment right now on the ground when it comes to these businesses and residents really trying to get about around their business in New Zealand?
It's certainly very, very patchy. There are green shoots, but there are also wilting plants, and that's quite typical of a recession. But what we are seeing in our business survey, and indeed going out and talking to businesses, is that those sectors that are most sensitive to interest rates, they've had the biggest crunch, but they're also the first ones to be showing signs of life. So the housing market in particular, the percentage of houses successfully selling at auction has jumped quite markedly. So even though sales are still relatively flat and prices are still falling, the vibe is definitely turning upwards for housing. The construction sector in our business survey has had the most ferocious upswing in confidence, employment intentions and the like. So I think the Reserve Bank can take comfort that rate cuts are going to work. You know, there's no emergency here in that regard. So our take is certainly that the market has gotten a bit of ahead of itself in terms of not only predicting 50 now, but an ongoing series of very aggressive cuts. If anything, it looks like the economic data could actually surprise the Reserve Bank to the upside from here. That said, we're in a pretty dark place here and now, so that isn't necessarily a threat to the disinflation track that we're on.
What does that mean for the Kiwi dollar? We've already seen significant pressure, but at the same time, we do have the Fed not necessarily rushing to cut either.
Yes, it's going to be an interesting one. We have a governor who seems to have taken a vow of silence about the exchange rate. He refuses to be drawn on offering an opinion on where it is or where it should be. I think, yeah, the dollar has had a risk overlay on it, a sense that the New Zealand economy is doing very badly. But my sense is that we could start to see some of that data surprise on the upside, and that could perhaps be a positive for the dollar. At the same time, that if markets after today are still more confident that the Reserve Bank of New Zealand will be cutting more aggressively than the Fed, for example, then that could go the other way. So it's hard to be definitive. At the end of the day, the market's going to make its own judgment about whether the Reserve Bank has got this right or wrong.
We've seen a lot of New Zealanders already make that judgment, right, in terms of just a record exodus of Kiwis that we've seen. A lot of them have been headed for Australia. Longer term, do you see this as an ongoing risk in terms of, I guess, not just the ongoing brain drain, but the question of productivity and you know, the competitiveness of that landscape for New Zealand?
Yes, well, because New Zealand's a relatively small country, we can move the dial in terms of demographics through immigration, and we certainly have recently. But I think most people would say that we've had unhelpful lurches in migration policy. Now, some of those were, of course, health policy rather than migration policy, with the closed border for so long during COVID. And then we had the tightest labour market on record, and then the doors were thrown open to an extent we haven't seen for a long time. So we've definitely had massive swings increase in migration. I think it's generally accepted the focus has to be on getting in the skills that we need, because if we just import unlimited amounts of very low-skilled labour, then that's actually going to disincentivise investment, which at the end of the day, productivity has a huge say in your medium to long-term economic outlook.
There's also external vulnerabilities, and I do wonder, if you're already starting to look at what the different outcomes could be following the November US election and what that could mean in terms of implications for trade with New Zealand, for example.
We don't sell a huge amount to the US directly, so much. It's really about China. So the impact of the US trade policies on China would probably be the more important channel rather than the direct one. Fair to say our commodity prices have been doing a little better than expected lately, with demand for dairy products holding up better than feared. And now, of course, we have stimulus measures in China. Certainly has had a dramatic impact on the equity market, which could then feed through into more robust consumer confidence and a little bit more willingness to spend on the nice-to-haves. Most of New Zealand's food exports probably fall into that category in China. The proteins in particular are much more expensive than the homegrown options. So we'll be certainly hoping that that's a positive. Then you've got the situation in the Middle East, and oil prices could be a negative. So a very mixed picture, but overall, here and now for New Zealand, probably that global environment has not been as much of a dampener as was feared.
Certainly a lot going on. Sharon, really great to have you with us on RBNZ Decision Day. Sharon Zollner, who's a chief economist at ANZ New Zealand. One of the other stories that we're following on China is the investigation into whether to raise tariffs on European large engine vehicles. They'll start collecting levies on brandy. It is an escalation of their trade spat after the EU voted last week to impose tariffs of up to 45% on Chinese electric vehicles for 5 years. The European Commission says it'll challenge the Chinese measures on brandy at the WTO. More ahead on the Asia trade. This is Bloomberg.
Investors in Japan are turning to a trusted strategy in the countdown to a national election as they face uncertainty over the U.S. presidential vote and tensions in the Middle East. Senior Asia stock reporter Hideyuki Sano joins us now for more on this. And Hide, is this sort of the age-old story of spending in order to get those votes?
I think that's what people are thinking. I mean, to be honest, there's no clear consensus on why exactly this, why Japanese share prices tend to do well before the election, but it's very interesting that the Japanese stocks tend to do well after the parliament is dissolved and before the election date. So there's a period of a few weeks, and in the past 11 times, in all of them, Japanese share prices rose. So people think that basically it is a very good time to buy Japanese stocks, at least in the very short term.
So the lower house is expected to be dissolved as early as this afternoon, and then we have the general election on October 27th. So that's the sort of period of time that we should be watching for that upside. But what happens after October 27th?
Yeah, I mean, that's probably a more important question for investors. And the results are mixed. In the past 11 episodes, the market fell 7 times, so that doesn't really look very good. But on the other hand, the declines took place mostly in the 90s and early noughties when the Japanese stock market was collapsing. So recently, the market rose 4 times out of 6 after 2005. So that isn't that bad. And this time, some analysts think that Prime Minister Kishiba might want to keep the economy going and try to support the economy as much as possible, because he has to face another election next year, because there's an upper house election probably in July.
What are the market expectations in terms of how the LDP will perform?
Yeah, I mean, we haven't had a lot of polls yet, but the early indications we have is the LDP is likely to lose some seats but retain majority. That makes it possible for Ishiba to keep his place, unless the LDP does so badly. So if that's the case, probably there won't be a huge impact on the course of Ishiba's policy, and many investors expect that. I mean, Ishiba has flip-flopped on a few issues, so there's some uncertainty. But that said, generally speaking, I think most investors think Ishiba will generally follow Kishida's policy.
Bloomberg senior Asia stock reporter Hideyuki Sano here, and of course we've been following Ishiba's policies, especially when it comes to that flip-flop on that relationship with the BOJ, which continues to gradually tighten. Japan now seeing the highest number of bankruptcies since 2013, this on also rising costs hitting companies. A report by Teikoku Data Bank showing that nearly 5,000 firms went bankrupt in the 6 months through September, up 18.6% on last year. A record 472 firms cited inflation as the main reason. Japan's key price gauge has stayed at or above the BOJ's 2% target for over 2 years as the weak yen inflates import costs.
Another story we're following, FTSE Russell is adding South Korean bonds to its benchmark index after months of official campaigning and an overhaul of financial market infrastructure. The addition could attract tens of billions of dollars of inflows. To fulfill requirements for the index, South Korea has made it easier for overseas investors to settle bond trades. FTSE is also adding India into its gauge for emerging market debt. We're getting at more on this in the next hour and speaking to Nikki Stefanelli, who's the Global Head of Fixed Income, Currencies and Commodities Index Policy at FTSE Russell. This is Bloomberg.
This is the Asia Train. Here are the latest from the corporate front. Hyundai is seeking to raise as much as $3.3 billion through an IPO of its Indian unit in what could be the country's biggest ever listing. Hyundai has set the price range as high as $23 per share, which could value India's second biggest car maker by sales at $19 billion. The IPO will open for bids next week, with shares expected to start trading October 22nd. Brazil's Supreme Court has authorized the return of social media platform X after Elon Musk complied with its demands. That includes removing some user accounts and appointing a legal representative in the country. The order ends a months-long feud between Musk and the Supreme Court, which blocked X in August after Musk flouted Brazilian regulations. Japan's Norinchukin Bank is said to have sold its first dollar bond since signaling massive losses earlier this year. A source says the lender's $500 million 5-year green bond was priced at 1.23 percentage points above treasuries. The proceeds will be primarily used to finance or refinance environmental-related projects. Honda says it's open to revising its EV strategy if demand for pure battery cars continues to wane. Its CEO told investors the company may adjust the timeline for establishing EV factories globally if needed. That could include delaying setting up some battery production lines. Automakers worldwide have been dialing back their EV ambitions as consumers cool on battery-powered car purchases.
Hon Hai Chairman Young Liu says the company is planning to boost server capacity to meet stronger than anticipated demand for NVIDIA's AI chips. Speaking to us at the firm's Tech Day in Taipei, Liu disclosed for the first time how many servers they plan to make for the next year.
We see the demand is over what we can ship.
So if you can't meet the demand right now, how long do you see that extending for? What sort of sales do you have booked going into next year as well?
We see in maybe somewhere around 20,000, that kind of a number.
You're looking to ship 20,000 AI servers made with Blackwell chips over the course of next year. Is that right?
Right.
Okay, and any particular quarter that you're looking at in particular for that, or do you see it being
It's not
spread
per quarter,
out?
that's a year.
Yes, but per quarter, are you expecting a bulk of those to go in one particular quarter, or do you see it spread evenly across the course of this year, or next year rather?
It really depends on once we start shipping, the demand, whether the demand will change or not. If the demand doesn't change after we start shipping, and the demand will be even higher than we expected.
In terms of profit margin, then, what I understand for AI servers, it can be in the low teens. Do you see a way to expand that and to increase it?
I think in the low teens, you're probably right, but that will have to be based on how much vertical integration, how much components that you're able to provide. So with that, it varies to a certain degree. But because the CPU and GPU is very high price, so the rest of the server, has only some limited impact in terms of overall cost.
On Hi, Chairman Young Liu speaking with Bloomberg tech reporter Annabelle Jewelers in Taipei. Take a look at how we're trading right now with the ASX 200 rebounding from those losses in the previous session. Kiwi stocks also gaining ground for the first time in 3 sessions. And of course, we do have the RBNZ likely to cut rates today. Nikkei futures pointing to the upside of more than 1% at the moment. We saw a day of losses for the Nikkei, and of course, we are expecting the dissolution of the lower house this afternoon in order to head to general elections on October 27th. U.S. futures not doing much. We saw some gains in the overnight session. Magnificent 7 stocks, chip makers led the gains, so we'll be watching the tech sector very closely today. The market open in Tokyo is next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. After we saw some gains overnight on Wall Street, Haidi, of course, we are looking forward to U.S. inflation numbers. Tech led the gains, but in the Asian session, we'll also be watching those China-exposed stocks, given that we didn't see that major stimulus package that the markets were expecting.
Yeah, the question is whether it really is a sign that markets are wanting more, or whether we'll start to see that catch up when it comes to onshore assets as trading gets underway properly today. But of course, we're also watching Asian central banks from the RBI to the RBNZ. When it comes to New Zealand, there is that real possibility that they could go big with a 50 basis point move.
Take a look at how Japan is coming online. South Korea is actually away on holiday, but we did see the FTSE Russell actually adding them to their benchmark bond index. Right now, Nikkei futures were looking to the upside, so if we could see a little bit of a pop at the open when it comes to the Japanese yen, still holding steady at that 148 level. Take a look at the Nikkei now coming online, gains of more than 1% early in the Asian session. We continue to see this voice and support of unity coming from policymakers across Japan when it comes to the BOJ and the work that it's doing in normalizing policy. Right now, we'll be watching JGB yields still holding below that 1% level, and those China-exposed stocks, of course, will be key, Haidi.
Take a look at how we're tracking when it comes to an hour or so into the trade of the cash session here in Sydney. And we are seeing a little bit of upside there, just about 0.5% higher when it comes to the ASX trading at the moment. The Aussie dollar is largely unchanged at 67.39. Of course, seeing how we kind of approach the China story today, given the disappointment over a lack of further details or further announcements of spending from the NDRC briefing yesterday, we had that sort of sympathetic reaction when it comes to some of these China proxies like the Aussie Aussie dollar. Also watching treasuries as well, as of course that conversation continues to brew over what we could see from the Fed. We had a bit of Fed speak sort of in the overnight session. The Vice Chair, Philip Jefferson, saying the risks to the central bank's employment and inflation goals are now closer to being equal. We had also heard that rate cuts should be careful and data-based from the Boston President, Susan Collins, there as well. So, Shery, that debate when it comes to, you know, the resilience of the US macro story and what we see in Asia continues to brew.
Yeah, as we're setting up for that U.S. inflation numbers on Thursday as well. Our next guest says that investors can capitalize on the tech growth story across the U.S. and also Asian markets. Ecaterina Bigos is CIO for Asia ex-Japan Core Investments at AXA Investment Managers, and also joins us here in the Tokyo studio on a very rainy day. When it comes to the Asian markets right now, we're seeing tech leading the gains. Not surprising given what we saw in the overnight session.
Yeah, certainly. And if you look at the beginning of the year, I think, and starting from last year as well, I think tech has led that rally. It's been a very narrow rally across the board, not just in Asia, but also in the US. And that's largely been driven because the tech company that's led that rally are well capitalized. They have strong business models, and they were able to actually deliver those earnings. And certainly the AI excitement has led to some of that support across the board, the US and obviously Japan being part of that supply chain story.
What does it mean when it comes to Chinese stimulus measures and also the potential more upside that we could get from here?
Yeah, and I think the China stimulus was well desired by the markets. I think market was at risk, or China is still at risk until we see it in the data, in that entry into that deflationary spiral. And I think the measures that were put in place give somewhat a floor, a confidence that the policymakers are paying attention to the weaker data. And I think market has reacted in that manner. Now, what we need to see the next stage, we need to see a lot more fiscal stimulus. And certainly yesterday, we've seen the policymakers come and not giving details around what that fiscal stimulus is going to be. And I think the attention will be around 27th of October when they meet to actually provide additional potential details around the fiscal stimulus.
So without that fiscal pledge, do you see this rebound as being short-lived?
And I think this is the ultimate answer. I think it's a couple of stages we have to look at China rebound. We have to look at the first stage, the ability of the first set of measures bringing that inflation cycle back into the China economy. And I think that will impact positively the earnings for corporates and ultimately will sustain some level of performance for China market. When you look at fiscal stimulus, I think this is probably focused more on a longer-term story and addressing some of the structural challenges that, despite the measures that we had at this stage, the structural challenges are still very much present and are likely to drive the mid to long-term performance of China's equities.
There's a lot of uncertainties as we head into the end of the year, right? Geopolitical amongst them. You talk about thematic investing as still being one to kind of rely on. What themes do you think will be durable for the next few months?
Yeah, we've talked since the beginning of the year extensively to clients around technology, robot technology, which I think is taking a more solid space when it comes to taking a bigger part in clients' portfolios. But also, if you look at the drivers and the support drivers for that theme is quite secular. It means that the shifts that we see in the labor markets, where a lot of the processes are becoming a lot more automated, and certainly the replacement of some labor with automation, certainly supporting the robot technology. Then we've seen the excitement around AI, which has supported the tech cycle even further. And as I said earlier, we're not to be, again, disillusioned that the first stage has impacted positively well-capitalized companies that were able to deploy into that development, and companies that are part of that supply chain to develop the AI, so which are the semiconductors, which have benefited companies in Taiwan, certainly companies in Japan. So still quite a narrow rally, but it has scope to broaden out as we see applications being put in place on that artificial intelligence story.
And given that we do have U.S. inflation numbers coming out, and of course we're still gauging the Fed's trajectory, that they're not necessarily in a rush to cut rates, how's that going to impact tech, especially perhaps not the so well capitalized companies that still need to make those investments?
Yeah, and I think if you look at the first step that Fed has taken in this policy normalization, I would say it was probably a very courageous step, and I would say probably in magnitude somewhat surprised ourselves. We didn't see it in the data, and as of course we had the payrolls numbers coming in on Fridays indicated that the U.S. economy is staying a lot more resilient, that potentially the Fed would have had data at that meeting. So the one point to say that certainly the U.S. economy is staying resilient, which is positive, I think, for well-capitalized companies that I've talked about, but also has scope to support the smaller companies. And the second stage of it is for smaller companies to start performing when you see the leverage coming back on the balance sheets, the ability for them to start deploying into development and growth. And I think it's all dependent on the Fed being able to normalize and continue to normalize that policy with guidance and with clear guidance. Yeah.
The Fed not rushing, what are the implications for Asian policymakers? We do have the RBNZ, the RBI, the BOK later in the week as well deciding on policy.
I think Fed plays a role in decision for policymakers in Asia and globally, but I would say the macro dynamics in individual country, I think I would say more superior. Each of those have to look at particularly the inflation. The inflation has been the key driver of policymakers being either hawkish or dovish in terms of the ability to ease from this stage the monetary policy, and I think a lot of attention is still paid on the macro dynamics in individual countries.
Especially when it comes to how the Japanese yen reacts and the yen carry trades, right? Are you watching that closely now?
Yes, of course, and I think we've watched that, and we'd have thought that the biggest volatility for the yen is probably past. I think the new government is coming in. I think is visualizing the policy put in place that will put in place as a continuity. I think some pragmatism around how fast the BOJ can move their monetary policy is certainly something to watch. Yeah.
Ecaterina, really great to have you with us. Ecaterina Bigos, who's the CIO for Asia ex-Japan Core Investments at AXA Investment Managers. And we were talking a little bit about tech driving really this part of the move that we're seeing across Asian markets at the moment. And we are really seeing some of these Asian chip makers today showing leadership. Tokyo Electron up by 1.5%. We're seeing some even bigger gains when it comes to laser tech, as well as Disco Corp as well, over 3% gains there, following the gains that we saw on the Wall Street session overnight.
Okay, I'm next. Take a look as well at Nintendo, Haidi, and perhaps some of those game stocks that we've been watching across Japan, because we had just heard this week that the senior executive was saying that they were weighing deploying more capital into this Kyoto-based games company, Nintendo, right? But now we've actually heard that Saudi Arabia Sovereign Wealth Fund has now disclosed that it's actually sold down its stake in Nintendo. So the public investment fund selling about 17.3 million shares of Nintendo, and we're seeing the stock now losing almost 2% right now. Still ahead, Israel's defense minister postpones a planned visit to Washington for talks on a common strategy against Iran. An update on the Middle East crisis coming up. But first, we look ahead to the RBNZ's rate decision due in the next hour and why most economists expect a 50 basis point cut. This is Bloomberg.
Ahead of the RBNZ decision, take a look at how we're seeing Kiwi assets trading at the moment. A bit of back and forth when it comes to trading in the Kiwi dollar. We did see some leadership earlier, but now we're having the Kiwi trading at pretty close to that 4-week low going into that decision, just above that 4-week low. In fact, we have seen expectations that they're likely to quicken the pace of easing to get ahead of the economic weakness that we see. We saw the Kiwi dollar in the previous session closing up to arrest that 5-day slide, but really very much at the mercy of a key week reversal that started at the beginning of this month. Also watching Kiwi bonds there as well, bull flattening in the yield curve that we're seeing before that meeting. Of course, the forecasts are potentially seen to be a cut of 50 basis points there. We also see treasuries rising for the first time in about a week before the release of those Fed minutes. Also looking for inflation data out of the US as well. That vulnerability, though, when it comes to the Kiwi dollar is very much front and centre. Let's bring in Paul Allen for more on what to expect from the RBNZ. So it's interesting when it comes to how they balance this, right? Because there have been some indicators that things maybe are starting to come off the bottom.
Yeah, that is true. The data points are few and far between at the moment, however. I mean, we have had inflation pull back. Headline number now, 3.3% in New Zealand, and some remarks from Adrian Orr in the past couple of days that risks to inflation are now more balanced. But that's come at a cost, right? The economy's slowed down considerably. There's been a sharper than expected worsening of the labour market. And of course, last month, GDP slipped into contraction as well. The next set of GDP numbers, not until December, so it's not until then that we find out whether or not New Zealand has a triple dip recession. But in the meantime, as you say, consensus is action today. 22 economist forecasts, all but 4 see a 50 basis point rate cut and the other 4 see 25.
As you say, in the absence of sort of more data, what does that tell us about the path ahead?
Well, the consensus is more to come. It's just the only disagreement is how much. Do we get another supersized cut at the next meeting? That next meeting not until November. Bloomberg Economics says, yes, there will be another 50 basis points in November, but not everybody is so convinced. The next CPI reading's pretty soon for the third quarter. That comes next week, but we don't have any forecast for that yet. But as I say, the next GDP reading not until the end of the year. So that next RBNZ meeting lands in between those two events. But overall, the scene is definitely set for an easing bias, and the scene set also for New Zealand dollar weakness.
Paul Allen here in Sydney.
Heidi, we're also watching, of course, the Reserve Bank of India. It has a rate decision later today, and it could be the first under a new monetary policy committee when most economists now who have been surveyed expect the RBI to hold at 6.5%. Several others predict a switch to a neutral stance for the first time since 2019. HSBC says a change in the policy stance could pave the way for a quarter-point cut in December. We're also watching South Korea. Most economists expecting the Bank of Korea to begin its easing cycle when it announces this policy decision on Friday. Bloomberg opinion columnist Daniel Moss believes South Korea has earned a victory lap on rates. Dan joins us now. And Dan, of course, this could be the first cut in, about 4 years. But why is it so significant in the global policy-making landscape?
You know, it's significant because typically business stories about South Korea are about chips, or they morph into discussions about K-pop and cinema, when really the economic policy story in Korea is quite compelling. Friday, assuming they do cut, is important because South Korea was the first country of any consequence to lift interest rates, and they did it in the teeth of the Delta variant. Remember that? It's been a long time since anyone's talked about this. This was in August 2021. It was so much easier for policymakers to go into a defensive crouch if virus numbers started to pick up. You were just talking about the RBNZ earlier. Remember, they had a single case in August 2021 and the entire country shut down. What looked like a sure thing for a rate hike in New Zealand was punted a few months down the track. South Korea pressed ahead. So now that the time has come for them to ease, whether it's Friday or whether it's next month, it's coming. This, in some ways, marks the turn of the global cycle. Let's not forget, the Fed, which gets a lot of attention, justifiably so, didn't hike until March 2022.
Dan, the other thing is, of course, independence for central banks away from political influence is a given but not always easy to maintain. Independence from the Fed when you're not the Fed is a different thing altogether, right?
Yes, and the BOK governor, shortly after he took office, gave a speech to the Peterson Institute for International Economics in Washington. There were a couple of quite witty asides that he made. He observed that being governor was quite a bit harder than writing an academic paper. But also, look, he said, we have independence from the Korean government, independence from the Fed. Well, that's a lot harder to achieve. So, look, there's no question, the Fed is first among equals, cardinal of the College of Central Bankers, pick your metaphor. But what I'm trying to do in this column today is give South Korea some credit. They went out there and started hiking when it wasn't easy.
So let's give them credit where credit is due, but at the same time, I do wonder, South Korea is such a unique economy, right? I mean, surging housing prices, apartment prices are insane even right now. And not to mention household debt is also high. So in a way, was it slightly easier for the BOK to hike rates before everybody else did?
You know, I don't know about that, Shery. I mean, you know, there was still plenty of fear and trepidation around, you know, in August 2021. Inflation had begun to pick up in many economies, but over at the Fed, the T word was still in vogue. And sure, when you talk about South Korean property market, just remember we're talking primarily about Seoul. The population of South Korea, as you would know, is extremely concentrated in Seoul. There's more to the South Korean economy than Seoul. And by the way, you know, adjustment in interest rates are not necessarily going to solve this property issue in Seoul.
Yeah, when it comes to just investing your wealth in property, right, across Asian countries overall. Dan Moss, good to have you with us. Bloomberg opinion columnist here. Of course, we're looking ahead to the BOK rate decision on Friday. This is Bloomberg. Take a look at oil prices rebounding early in the Asian session. We saw a little bit of pressure as China's top economic planner ended that highly anticipated briefing on Tuesday without new stimulus measures. But of course, we continue to watch the geopolitical tensions, not to mention Hurricane Milton having shut down some oil facilities in the U.S. as well. But Haidi, it's really about what's happening around Iran. There was some local media report in the U.S. that Israel could still be considering striking some of Iran's energy facilities.
Yeah, there is that sense of sort of wait and see for that expected reprisal, right? The Pentagon, in the meantime, Shery, says that a planned US visit by the Israeli Defense Minister has been postponed. Bloomberg's been told it's because of last-minute objections from Prime Minister Benjamin Netanyahu. Bloomberg's Michael Heath joins us now for more. I mean, can we glean any insight into, the frictions in that relationship?
Yeah, I mean, there are a lot of frictions there. I mean, to the point that Gallant, the Defence Minister, was actually dismissed a while ago, and that was several months ago. I mean, more than several months ago, and it was only through public outcry that he was reinstated. They've had a very fractious relationship. He wanted to attack Hezbollah shortly after October 7th. He thought they were on the back foot, and that was a good time for Israel to hit. Netanyahu disagreed. He wanted a ceasefire and to try and get the hostages out of Gaza. Netanyahu again overruled him. Prime Minister Netanyahu obviously has to think about his very right-wing colleagues who keep his government in office. So he just can't afford to compromise there. The relationships had some issues, and in this case. It seems like Netanyahu's, from our reporting anyway, that he wants to speak to President Biden first. I've read some separate reports saying they haven't spoken in a couple of months, and there's been some other interesting stuff that's come out about their relationship. Bob Woodward of Watergate fame has put out a book, and there's various reports showing some pretty choice words he used about Prime Minister Netanyahu, which I guess we would expect, given that Israel has sort of disregarded the US view in many cases too.
Well, it is that disregard, right? Because you continue to hear from the US and from the Biden administration that they are optimistic about, pushing for a ceasefire. We don't really see any signs of that multi-front operations being continued by Israel.
Yeah, and I mean, in fairness to Israel, they've had such an amazing amount of success, particularly with Hezbollah. Gaza less so, obviously. I mean, it's just been reduced to rubble, and there's still, rockets were being fired from there on the 1-year anniversary of the first attack. So, but just the ability to really wipe out the senior echelons of Hezbollah, and again last week they managed to kill the replacement for Nasrallah, and potentially the replacement of the replacement as well. There's no confirmation of that, but the bombing was pretty severe, and these officials were believed to be there. So, I mean, the US Israel has sort of disregarded the US, but when it comes to Iran, I suspect they'll take it a bit more into account. I mean, this is an international issue. If things go wrong, they're going to really need the US by their side, because Iran has options in terms of its proxies around the place.
Mike, but when it comes to that direct hit from Israel, when can we expect some sort of signs on what that retaliation might look like? We're hearing from media reports that Israel could still be considering hitting energy facilities.
Yeah, I mean, Shery, there is one of the opposition leaders in Israel has said that that they should disregard what the US is saying and nonetheless target the energy infrastructure there. I mean, they do have various options. Obviously, the one that people outside of energy, the other one that people are very concerned about is Iran's nuclear program. But the difficulty is that Israel needs to really make a point here. I mean, it was attacked. I don't want to say it was an unprovoked attack. Obviously, there's been the fighting with Hezbollah and in Lebanon, but state to state, it was unprovoked, and so it does have to respond severely. And you know, the oil is so integral to keeping Iran going. Iran has its economy is not in good shape. It has a very young population that's discontented. There's a lot of unemployment. So the temptation for Israel there would be high. On the other hand, you know, you've got a US election coming up. They certainly don't want oil prices skyrocketing, and you know, the potential for, as the CIA director said recently, of something going wrong in these, you know, pinpoint strikes and a regional conflagration going off. It's all very, very possible where we are now.
When you take a look at, I guess, an endpoint for any of these conflicts, obviously October 7th and the response to that has sparked now this regional situation. But I do wonder, returning the Israelis to the north might be one of the goals for Lebanon. For Gaza, as you say, it continues with, you know, various degrees of what could be described as success. So how does this play out?
Yeah, well, I mean, I think, and this is one of the White House or the Biden administration's real frustration, is there's no end game. There's no political goal or objective here that they're aware of. And that's the difficulty. And Netanyahu can't set one because if he talks about negotiations with the Palestinians or some form of autonomy or state, then his government will fall from office because these nationalists will walk out. I mean, these are really, really extreme individuals he's brought into government. So he's cornered there. It just seems to be like the constant prosecution of war. Now, it's worked in his favour recently with these amazing results with Hezbollah. But the past year, OK, I'm sure they've degraded Hamas. But by the same token, you know, on October 7th, 2 days ago, Hamas was able to fire rockets into Israel. So they're still there. And obviously, you know, in these devastating scenes, they'll be recruiting as well because people will be very upset.
Yeah. Bloomberg's Michael Heath there. More ahead on the Asia trade. This is Bloomberg. Take a look at how bonds are trading across the Asia Pacific at the moment. Of course, we're watching treasuries as the debate over what we see next from the Fed really continues. But some moves when it comes to China in particular, sovereign bonds are extending that stimulus-led slump after the holidays. And we are seeing that sell-off kind of reflecting the rebalancing from bond allocations to equities. But of course, some uncertainty there, given that we have seen something of a pause in the take-up of that equities rebound there as well. Watching Kiwi bonds going into the RBNZ and that Japan 10-year yield, they're largely unmoved. We have seen sort of some of the data showing that the Japanese have bought a record amount of US sovereign bonds in the month of August. In the meantime, that super long yield gap for Japan is close to the biggest in about 2 decades on the rate hike outlook for the Bank of Japan. Staying with bonds, and FTSE Russell is adding South Korean bonds to its benchmark index, capping months of official campaigning and an overhaul of financial market infrastructure. The next provider also added India to its gauge of emerging market debt. Let's bring in Nikki Stefanelli, who's the global head of FICC Index Policy at FTSE Russell. Nikki, great to have you with us to talk through these decisions, because I have to admit the decision on inclusion for South Korea would come as a bit of a surprise to a lot of market watchers. There were many, including the likes of Nomura, Goldman's, that thought maybe 2025 was more likely timing. Does that mean those concerns over settlements through Euroclear have been sufficiently resolved?
Hi, thanks for having me. So the WGBI is, our flagship measure of investment-grade global sovereign bond markets. It represents kind of the highest threshold for accessibility for international investors. We've been monitoring Korea on our watch list over the past 2 years, and we've seen a series of reforms be implemented over that time, which we've been monitoring through our country classification process, which allows for a semi-annual review. At this stage, we took the decision to upgrade South Korea and announce its inclusion at the end of next year in November. We think that this longer lead time will allow market participants to have kind of the clarity that they need to kind of undertake various readiness activities to facilitate a seamless inclusion of Korea into the index in November of next year.
When you take a look at the weighting that's been projected and the engagement that we've seen, not to mention kind of the broader backdrop of just overwhelming interest of late in Asian bonds, what do you expect the broader impact to be?
Well, we know that WGBI has kind of a broad footprint. We know that usage kind of spans the globe. We have, a large user base that sits in Asia. We know that it will kind of drive flows. FTSE as an index provider kind of aren't in the business of predicting the level of those flows for various reasons. WGBI users have different kind of investment strategies that they use, ranging from extremely passive to extremely active. But, we're doing everything that we can to kind of prepare the market and communicate information about the expected exposure of the market in the index, timing of inclusion, and how that inclusion will kind of work during a phase-in period.
We know that South Korea has really made lots of efforts in the last couple of years in order to get included. Unlike India, because India's debt still isn't settled via Euroclear, or foreign investors still finding it very tricky to do business there. So what was the rationale behind really including them in your gauge for emerging market debt?
Yeah, so it's a good kind of point of comparison. So the WGBI does kind of have a higher bar to kind of clear if you think about kind of the expectations for global investment grade bond investors than emerging market portfolios. We've seen progress be made over the past few years that we've tracked India on our watch list for inclusion in our EM index. It's really, I think, clear to us that it is part of the mainstream EM choice set. It's becoming a more and more important part of those portfolios. So, based on feedback that we've received, we also announced inclusion of India for our EM index, which, again, kind of has the accessibility expectations calibrated to that peer group, which is, of course, different from a largely developed market index like the WGBI.
How much has the fact that Russia's has been excluded from global benchmarks, given the invasion of Ukraine, really weighed into your thinking? We have seen global funds really trying to get more exposure in the emerging market debt as well.
Diversification is, of course, kind of a factor for bond investors in global portfolios. As an index provider, we're kind of agnostic to some of those relative value decisions. We really kind of look at the choice set that's out there for our index users and take decisions based on the structure of a market itself, rather than, some of the more kind of rebalancing dynamics that kind of go along with, situations like in Russia.
So in terms of New Delhi, what sort of changes are you expecting to see? What would you like to see in order to make it easier for global investors to access the market?
Well, India is not kind of a candidate for the WGBI at this stage. WGBI does have kind of those really high expectations in terms of accessibility. Importantly, it also requires that the markets have a minimum credit rating of single A. So it's not on our radar at this stage for inclusion into WGBI. It's really kind of a decision that's really oriented around those EM global portfolios.
When you take a look at the sudden downturn that we're seeing across Chinese sovereign bonds and the allocations there, and I suppose a broader sort of uncertainty as to whether we are seeing that shift back into equities and the turnaround in the China story, how much impact does that have across sort of the correlation to other emerging market bonds and within the index?
I think our role as an index provider is really to kind of put together peer groups of markets. Some of those considerations around asset allocation and the like are, we're agnostic to those in terms of, individual investment decisions. So for us, it's really about kind of providing our index users with reliable information, transparency, the information that they really need to, manage their portfolios to our indices.
Nikki Stefanelli, good to have you with us, Global Head of FIC Index Policy at FTSE Russell. And take a look at how broader Asian markets are trading at the moment. We're seeing broad upside right now. We had some gains on Wall Street being led higher by the Magnificent Seven. So tech stocks are leading the gains in the Asian session, as well as we're headed towards that RBNZ rate decision expected to cut. We're seeing Kiwi stocks gaining for the first time in 3 sessions. We have more ahead on the Asia trade. This is Bloomberg.
This is the Asia trade. Hurricane Milton has regained Category 5 strength as it churns towards Florida's west coast, where flooding and high winds may inflict widespread damage and put lives at risk. Milton could potentially deliver the Tampa Bay area's first direct hit from a hurricane in a century. The region is home to more than 3 million people, NASA's Kennedy Space Center, and Florida's largest port. We're also watching some of these other climate stories at the moment in terms of weather news from Australia. The Bureau of Meteorology says the nation is likely to see an above average number of severe tropical cyclones this season. The cyclones threaten Australia's gas operations, iron ore and coal industries, as well as sugar crops. The likelihood of more strong storms, is higher because of the warmer than average ocean temperatures forecast for the region in coming months. A new report by Norwegian risk management company DNV claims global emissions have likely peaked, but that the transition to clean energy remains too slow. The report shows the lower cost of solar panels and batteries are stunting the growth of oil and coal. However, DNV says hard to electrify sectors need a renewed policy push amid a growing mismatch in geopolitical and economic priorities versus the energy transition. Shery.
And Haidi, of course, we continue to watch the geopolitical tensions in the Middle East right now. Oil resuming some of those gains after falling in the overnight session. We had some pressure on that broad risk-off mood as we didn't get more stimulus measures coming from Beijing. But WTI and Brent had already rallied for 5 consecutive sessions or so. So we're seeing right now a resumption of that as well. As we continue to watch the metal space as well, because iron ore has been pressured, slumping from that 5-month high. Again, a lot to do with those expectations on seeing more measures coming from Beijing and the NDRC, the top economic planner, not necessarily providing those. We're also watching thermal coal and gas. This, as the top economic planner said, that it has enough supplies for the peak winter season. It also pledged to use more fiscal tools to encourage corporates to purchase green power. Let's cross to Beijing and our energy reporter, Dan Merton. Dan, so a little bit of a reversal when it comes to the recent statement coming from the NDRC when for years we thought that supply security was a concern. What's changed for Beijing?
Yeah, so basically 2 big things have changed. One is pretty traditional. In the past couple of years, China has really pushed its state-owned coal miners and gas drillers to produce more of the heating fuel. And production was at records last year and has stayed at really, really high levels this year. The second and probably more impactful change, though, is on the demand side. And that's because at the same time, they've continued this surge of new clean energy, solar panels, wind turbines, increasingly some battery storage, and hydropower has been really boosted this year by the rains in China. And so that's allowed a lot more renewable power to come onto the grid and meet almost all of the incremental demand that's been added this year from all the new EVs and data centers that are coming online. And so you combine those things, and even though power demand is really, really high this year, we're seeing, the demand from burning coal and gas hasn't really budged at all from last year. And so inventories are just at record levels. China is chock full of coal and chock full of gas. And really, for the first time in at least 5 years, we're going into a winter where the NDRC isn't really concerned about having enough supplies for heating, which, one of the few statements that they made yesterday that made Chinese people happy.
The broader story of the economy and the trajectory there, how does that connect when it comes to this path and policy path to net zero?
Yeah, Shery, it's a really important question because, on the side of the power sector, the path is pretty clear. China is just going to continue to roll out solar panels and wind turbines at world-beating rates, and that's probably going to be able to help them keep up with incremental demand and allow the power sector to sort of peak. But it's not just the power sector that emits carbon dioxide here. Steel, cement, petrochemicals, all these industrial sectors are big emitters. And these are places where it's much harder to just bring in clean energy. And so the economic trajectory makes a really big difference there. And we've seen big decreases in cement production and smaller decreases in steel production as well, as the property bubble has burst and we haven't needed to build as many new apartment buildings here. And so one question people are going to be asking is, as the economic recovery drags on and on and on, will China continue what it's doing so far and trying to keep the housing sector, basically prop it up but not overheat it again? Because if it reverts back to something like you saw in 2008, where we had this huge, high-intensity stimulus, based on infrastructure and building out, then you could see a reversal in those industrial sectors, which you could put China back on the path toward increasing emissions.
Our energy reporter Dan Murtaugh there joining us from Beijing. Take a look at 7&I right now. It's jumping more than 9% early in the Japanese trade. And this coming as we're now hearing that Alimentation Couche-Tard has sent 7&I Holdings a new potential acquisition price of $18.19 per share last month. This would value the Japanese company at $47.2 billion. This according to people with knowledge of the matter speaking to Bloomberg, a premium of around 20% from the prior offer. Of course, we have seen this new attempt to enter talks coming from Couche-Tard. They're not giving up on their takeover effort. We had seen, of course, the previous offer being rejected by the owner of 7-Eleven stores. The price was $14.86 back then, and we're now seeing an upped offer. But since then, we have also seen that 7&I has received the designation of being a core business essential to Japan's national security. So we'll continue to watch how these conversations unfold. But Bloomberg has learned that Couche-Tard has sent a new potential acquisition price that would give 7&I a premium of around 20% from the previous offer, Haidi.
Yeah, watching that very closely for further developments. But in the meantime, we're watching the China economy story very closely too, Shery. And tourists there shelled out less money during the long Golden Week holiday than before the pandemic, even as we see signs emerging that spending is stabilising after the stimulus barrage. For more, let's bring our China correspondent Min Lo in Hong Kong. So the calls really are for more fiscal and potentially more direct household payments, and potentially the lack of spending that we've seen in this holiday kind of shows the need for this.
Yeah, so the official data we got from the Ministry of Culture and Tourism showed that Chinese people took 10% more trips than before the pandemic, but spending was up only 7%. So if you calculate the per capita spending or per trip spending, that's actually fallen by 2% compared to pre-pandemic times. And this is despite some of the measures that have been rolled out just ahead of the holidays. Remember, the officials announced they were giving out cash handouts to the extreme poor. They were providing benefits to new graduates who haven't been able to find jobs, but that has not been enough to bolster per capita consumption. But the good news, though, is if you compare it to just last year, retail sales was up 9% and domestic cross-region trips was up 4%. So things are looking better than last year, but not better than before the pandemic. And so analysts are saying we still need more fiscal stimulus. We need home prices to stabilize and the recovery in the labor market for us to see consumption really turn around in a sustainable way.
Yeah, and that really disappointed markets, right? What are we expecting in terms of trading in the Chinese markets today?
Well, if what happened overnight in the U.S. is anything to go by, it doesn't look very positive for China markets open today, because if you look at the NASDAQ Golden Dragon that was down, the U.S. ETFs tracking China's stocks as well, those are all pointing downwards by quite a sizable margin. And yesterday was really a huge roller coaster ride, right? The CSI 300 opened at 10 or 11% in the morning, but then pared back more than half of the gains. The Hang Seng telling a completely different different story, opening up in the red and continuing to extend declines. It was down some 9% by the end of the day. And a number of factors are at play here. First is that disappointment around the NDRC press briefing that there wasn't more aggressive fiscal side stimulus that was announced. And secondly, perhaps traders are worried about sentiment being a little bit overheated, given that valuations of the Chinese equities are now above the historical mean when it comes to forward earnings. But some analysts are saying, look, don't be too bearish just yet, because remember we mentioned the NDRC doesn't have the mandate to increase fiscal budget deficit. There are still plenty of opportunities for the government to roll out a big bang fiscal stimulus, perhaps closer to the end of September. So that's something to look out for. But on the flip side, you have people like Morgan Stanley, Laura Wang, saying she's seeing very little upside to most of these indices. If you take a look at the chart, only the HSCEI, that's where she's seeing some potential upside. But the rest, she said, valuations have already priced in the potential for more reflationary measures, and she doesn't see any re-rating of these broad indices in the near future.
Ming Lo, our Bloomberg China correspondent there. We continue to see that upside when it comes to 7&I. We are seeing gains of more than 7% at the moment, and this, of course, after gaining as much as 12% at one point. Bloomberg learning that Alimentation Couche-Tard has sent 7&I a new potential acquisition price of $18.19 per share. That's a premium of around 20% from the previous offer. We'll have more on this story after the break. This is Bloomberg.
This is the Asia Trade, taking a look at some of the corporate headlines that we're following. And Hyundai is seeking to raise as much as $3.3 billion through an IPO of its Indian unit in what could be the country's biggest ever listing. Hyundai has set the price range as high as $23 per share, which could value India's second biggest car maker by sales at $19 billion. The IPO will open for bids next week, with shares expected to start trading on October 22nd. Brazil's Supreme Court has authorized the return of social media platform X after Elon Musk complied with its demands. That includes removing some user accounts and appointing a legal representative in the country. The order ends a months-long feud between Musk and the Supreme Court, which blocked X in August after Musk flouted Brazilian regulations. Shery.
Heidi, we continue to watch 7&I paring back some of those earlier gains after a jump of more than 12%. We are now hearing that Alimentation Couche-Tard has sent 7&I Holdings a new potential acquisition price. Let's bring in senior editor Reed Stevenson for more on this. And Reed, so I guess Couche-Tard is really not giving up on this potential takeover.
I mean, it just sort of signals another phase where Couche-Tard is quite determined to try and enter negotiations with 7&I. What we understand is that this new offer valuing the owner of 7-Elevens at around 7 trillion yen, it was sent back in September 19th. That's, several weeks ago. But we haven't heard any of this trickle out since then. And now it seems like talks are not really happening, at least in a substantive way. And we're just waiting to see now how 7&I is going to respond to this.
Because there has been some confusion as to whether this is ultimately about valuation, value for shareholders, or whether there's more sort of, national issues at play here, right? Does the response to this, will that give us a better indication as to whether there is a path forward and, which of these narratives are actually at play?
Yeah, indeed. I mean, it's just going to make it harder for 7&I to sort of reject an offer now that this is public, given that the only reason why the shares are going up is essentially this approach, as opposed to some of the news that we've been seeing over the past week of 7&I trying to shed off some of its non-core assets, really to sort of demonstrate that it's willing to focus on its core business, which is really, the convenience stores, which have been so successful over the past few decades. I mean, the other thing to note here is that, the timing is very interesting. We're actually going to get quarterly earnings from 7&I in about 2 days. And so I'm almost certain that, CEO Ryuichi Isaka is going to face some questions over this.
Yeah, we'll be watching out for that very, very interesting time as that effort to raise value will be in focus at that quarterly earnings appearance. Right, our senior editor Reid Stevenson there in Tokyo with the very latest as we continue to watch that Couche-Tard approach to increase their offer to $47 billion. Take a look at how it's shaping up when it comes to future. And of course, front and centre remains that China rebound story, right? The disappointment over the NDRC decision, the really continues to kind of feed into the narrative that more fiscal stimulus will be required to continue propelling this this rally into more of a fundamental territory. We are seeing FTSE 50 China futures up by 2.7%. Their TAIEX futures also looking like we're seeing some upside. S&P futures at the moment trading kind of more or less sideways at the moment. The markets have really kind of given that signal to policymakers that more stimulus, more fiscal is needed to fuel this rally. However, we do have really the focus on these stock swings as well, the biggest ever trading frenzy that we've seen for the day, and that looks set to continue into another day of volatility. This is Bloomberg.